Well, good afternoon, everyone, and welcome to our weekly webinar where we will talk about what we see happening in the global economy, financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our investment strategy. We are recording this webinar so those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I am joined on the call by my partner and colleague, Paul Tepsich, the founder of HighRock. Our financial planner, Bianca Tomlinson, is also on the call. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask questions. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About HighRock tab. Okay, let's start with what happened since we chatted last week. First, let's see what the top trending Canadian Google searches were over the last week. Over 500,000 people searched George Boole. Who is George Boole? Well, George Boole was the first professor of mathematics at Queen's College Cork, born in Lincoln, England, 200 years ago. Boole's translation of logic into algebra led directly to the creation of the computer via the work of Claude Shannon at MIT, who showed that the increasingly complex switching circuits required by telephone networks could be both analyzed and synthesized using Boolean algebra. Monday was George Boole Day, the 200th anniversary of his birth. Well, also at the top searches were Halloween and Heidi Klum's Jessica Rabbit costume. I do not make this stuff up. As well as daylight savings, Blue Jays outgoing VP and GM Alex Anthopoulos, and the Toronto Raptors. Yet again, financial news was shut out. So it's left to us to give you the all-important financial news recap. In fixed income, the U.S. bond markets were weaker after bond investors revised their expectations for the U.S. Federal Reserve's next interest rate increase. Canadian preferred shares and Canadian bonds were also a little weaker over the course of the week. Both Canadian and U.S. bond yields were higher as bond markets priced in a higher risk of the Fed raising rates in December. More discussion on that in just a moment. Big moves last week in U.S. and German equity prices. However, the Shanghai Composite was lower by a little over 3%. Generally, other markets were not significantly big movers. Well, our equity market chart of the week shows that since breaking the downtrend line on October 22nd, the S&P 500 has continued to trade higher to test selling resistance. While the Fed meeting was not conclusive necessarily, weaker economic data since has brought more buyers into the market, although volume has been lighter. We'll talk about the Fed meeting and U.S. economic data in a moment, but technically the market has moved into an overbought situation. If further buying emerges, the May highs of 2135 are now the next possible test. But the overbought nature of the market may first encourage some short-term profit taking and a test of buying support at the 2060 level. The greed or overbought level is high, but history tells us that it could go a bit higher. So we'll continue to monitor that as we go through into next week. In commodities markets, oil was considerably stronger on the week, while gold and nat gas were lower. The Bloomberg Commodity Index shows prices just off their lowest level since 2011, but a slight improvement on the week thanks to better oil prices. Volatility has settled below its recent 200-day moving average and has calmed down considerably since its spike in August, with little change on the week this week. Well, on Wednesday last week, the U.S. Federal Open Market Committee ended their two-day meeting and announced that they continue to see economic activity expanding at a moderate pace. Household spending and business fixed investment have been increasing at solid rates in recent months, according to the Fed, and the housing sector has improved further. However, net exports have been soft, the pace of job gains has slowed, and the unemployment rate has held steady. Nonetheless, labor market indicators on balance show that underutilization of labor resources has diminished since early this year. Inflation has continued to run below the committee's longer run objective, partly reflecting declines in energy prices and in prices of non-energy imports. Market-based measures of inflation compensation moved slightly lower. Survey-based measures of longer-term inflation expectations have remained stable. So the Fed remains optimistic about future economic activity, and as a result has stated that a December increase in interest rates remains a possibility, but it will be dependent on key economic data between now and then. Well, later in the week came some key U.S. economic data. The first reading on third quarter U.S. GDP came in at a lower than expected 1.5% growth rate. The year-over-year rate of growth is at 2%. Now, while the Fed does not put numbers on what is considered moderate, we think that this definitely has to be at the lower end of that range. Both U.S. personal income and spending came in at a lower than expected plus 0.1%. So we have been monitoring the consumer. The consumer has not been a major factor, although the consumer is 70% of the U.S. economy. The consumer has not been a major factor at this juncture. Certainly it has not been in the third quarter. We'll watch to see how the consumer develops and evolves during the fourth quarter. Core consumer prices remain well below the 2% target at 1.3% year over year. And yesterday we saw data that showed a continuing decline in U.S. manufacturing, followed today by lower U.S. factory orders. So in general, since the Fed's press release, we've seen somewhat worse than expected economic data. So we'll watch again as we see other data evolve throughout the process. Well, here at home, we saw the August reading on Canadian GDP, which came in at a positive plus 0.1%. We won't see the whole third quarter, the whole of the third quarter until next month, but it has turned for the better, and it appears that the mild recession of the first half is behind us. Well, last week, UBS released their Global Real Estate Bubble Index, which put Vancouver at number 4. At the same time, the Canadian Mortgage and Housing Corporation issued a report warning that home prices are now outstripping fundamentals in 11 of 15 major markets, and that 4 cities, Toronto, Regina, Winnipeg, and Saskatoon, face serious headwinds because of high prices and a surge in the supply of new homes under construction. Interestingly, Vancouver was not on that list. Well, around the global economy, Euro area core inflation was reported at an annual 1% for October, still well below the 2% target, but a slight improvement from September. Meanwhile, the latest indicators of Euro area economic sentiment have fallen back to somewhat less optimistic levels. The Bank of Japan kept its pledge to increase the monetary base at an annual pace of about 80 trillion yen at its October 2015 meeting. Policymakers said the economy has continued to recover moderately, though exports and production have been affected by slowdown in emerging economies. So what do we see coming? Well, from the bond markets, yield curves in the US, the UK, and Canada to a lesser degree steepened over the last week as central bank optimism, mainly at the Fed, adjusted bond investor outlook over the longer-term global economic situation. Short rates in Germany, the blue line that you see, remain below zero, still out to 6 years. In the U.S., short-term rates are now building in a 50% chance of a Fed rate hike in December. Well, high-yield bonds historically lead equity markets, and high-yield turned lower early in 2015. The S&P 500 followed in August. The move higher in the S&P 500 more recently has not been led or verified by a move in high yield. History will tell us that U.S. equity markets are ahead of themselves. We think that they're going to have to correct lower to lessen the divergence between these two indicators. Well, we have said this regularly, but we think equity markets just keep getting more expensive, and equity prices continue to move well ahead of what we think the fundamentals are telling us. 340 of the companies on the S&P 500 have reported third quarter earnings so far. 76% have reported earnings above the mean estimate, and actually the 5-year average is for 72% of companies to report above the mean estimate. So currently it is slightly better than the average, but 47% have reported sales revenue above the mean estimate, and the 5-year average for that is 57. So sales revenues are not being generated or not generating above estimate levels. The blended earnings decline thus far for those companies reporting is 2.2%. The estimated earnings decline at September 30th was 5.2%. So those companies that have reported better than expected earnings have brought that decline from 5.2% down to 2.2%, but it's still a decline for the third quarter thus far. Now, analysts are estimating earnings for the fourth quarter will decline by 2.7%. So that could possibly mean 3 quarters of declining earnings. The reasons given for earnings and revenue declines are slower global growth, stronger U.S. dollar, and lower oil prices. Now, with earnings declining and stock prices rising, the price-to-earnings ratio is rising, making stock prices more expensive. The 12-month forward price-earnings ratio is 16.5. This is compared to the 10-year average of 14.1, and as we reported regularly, just slightly below the highs of last May at 17. In the other metric that we like to look at, enterprise value to earnings, the S&P 500 companies are valued at current market prices at 12.5 times. Now, the 10-year average is 10.8 times, so it's well above that. And as we've mentioned on previous calls, in our tactical growth model, we're not much interested in anything over 8.5 times. So again, on many of our metrics, equity prices still remain very expensive. Well, when investors and traders borrow on margin to buy stocks, margin debt rises. When investors and traders decrease their margin debt, this tends to lead stocks lower, as it did in 2007 and 2008. Now, the most recent data shows that margin debt has been reduced from record levels, but stock prices have actually risen over the last few weeks. Again, here is a traditional correlation that is seeing a significant divergence. Something has to give at some point, so this is definitely sending up yellow flags as far as we're concerned. Well, in a low return environment, it is especially worrisome when there is so much outstanding debt that asset price growth may not justify the cost of that debt. Well, the Fed is focused on economic data now, and their next meeting, as they suggested in their October 28th press release. So financial markets will be focusing on it, and this could impact market volatility. This week, markets will be focused on the U.S. employment report, which will be released on Friday. As the Fed alluded to, employment has been softening in recent months, so they will certainly be watching closely. This data, however, is fraught with sometimes significant revisions to previous month's data. So we need to be cautious as to how dramatic the markets may respond initially. Nonetheless, if it will sway the Fed one way or another, financial markets will react, and so we'll have to be paying attention. Prior to the release of this data, we will see the ADP private payrolls report on Wednesday, which has sometimes been indicative of the Friday number, but has also sometimes, as in last month, has not been. So that doesn't necessarily give us the complete picture. But Friday's non-farm payrolls for October are expected to have grown by 180 to 190,000 compared with September's number of 142,000. Remember I said these numbers do get revised, so we will have to be watching what revisions come forward. Behind the headline numbers, labor market participation, which is at its lowest level since the 1980s, is expected to remain at the 62.4% level, and also average hourly earnings, which are another important gauge for the Fed in their concern over potential wage inflation. In September, average hourly earnings were flat. They're expected to have grown by plus 0.2% in October. Well, on Thursday, we'll be getting the Bank of England's interest rate decision. There have been mixed data from the UK thus far, but as price stability is the mandate for the bank's decisions on monetary policy, the coinciding inflation report will likely be also an important factor. On Friday, in addition to the U.S. employment data, we will see the latest from StatsCan. It is expected that we may see an increase of about 10,000 jobs in Canada. On the weekend, China will release its updated import and export data for October. This has been market moving recently as it gives us further intel on the state of the Chinese economy, which financial markets have been keeping a very close eye on of late, and of course a lot to do with the significant down move in markets in August. Well, we've often mentioned that part of our discipline process is not only to grow our and our clients' portfolios over longer periods of time, but to make sure that we also protect our capital when we think that financial market risk is rising. Well, this past week, an article in the Financial Times of London written by Mohammed El-Arian, the former co-head of PIMCO, one of the largest bond funds in the world, and now chief economic advisor to Allianz and chair of President Barack Obama's Global Development Council, well, he added credibility to our thesis, suggesting that tighter monetary policies in the U.S. and easier monetary policies in Europe and other global economies could heighten equity market volatility. And in that case, cash, as a result, can in fact provide an important element of resilience in times of uncertainty. Well, our goal is to ensure that we get good risk-adjusted returns over the long term and avoid chasing returns in the short term. And cash can be, as Mr. El-Arian said, very strategic in protecting our client capital. Paul, did you have something that you wanted to discuss with this slide?
Yeah, it's a little complicated and certainly a busy-looking graph, but and we haven't gone through all of the information as of yet. But late last night, S&P put out a report putting all the major U.S. banks, so Bank of America, Citibank, J.P. Morgan, etc., on credit watch negative for a possible downgrade, which they say could come as early as early December, which coincidentally would probably line up with the just before the Fed meeting in December. But basically what they've done is they've looked at all these large major banks and said they are, as you can see on the slide, global systemically important banks. But S&P has now looked at them and said they don't think they have the implicit support of the Fed, which regulates all the banks in the U.S. So the Fed has basically mandated to the banks that they have to have so much capital for total loss absorbing capacity, and they are not there yet. So they need to go out and raise significant amounts of debt to do so. And effectively that is to balance out their risk-weighted assets, which you can see since 2010 have grown fairly substantially. So, and this graph doesn't really reflect it, but I think what we can tell you is that pre-credit crisis 2008, these global systemically important banks are maybe, some could argue, in good shape, but they are really, really big. If they weren't big before the credit crisis, they are enormous after the credit crisis. So they've been moving towards trying to increase profitability, and in doing so, they've taken excess risk. So that's something we need to do a bit more work on, but it's also something that we need to keep our eye on and understand a bit better. And Scott, just one more comment on the previous slide in cash. We right now have our cash balances in a high interest savings account that pays us slightly more than a 10-year Government of Canada bond, and we're quite comfortable with the amount of credit risk we're taking for an overnight basis on our cash balances. So cash truly is an asset class. We can't just look at it as sitting in cash doing nothing. Sometimes doing nothing is the best thing you can do.
Excellent. Thanks, Paul. Appreciate the information. Well, that's it for today's regular discussion. If anyone might have a question, this is a great opportunity to jump in and ask.
I have a question.
Please.
One thing we didn't discuss, we've looked at the charts and it's quite dramatic over the past 2 months what the S&P 500 or U.S. indices, certainly not Canadian indices, but U.S. stock indices have done, and probably some others in Europe and Asia. The massive downdraft that we saw in August, and then almost a V-shaped recovery in the S&P 500. I mean, I think part of what's driving that is a massive short squeeze going on. But maybe we could look more into that. Do you have any comments or thoughts on that, Scott?
It could very well be. Certainly, as we have discussed, a lot of the day-to-day trading is computer-generated, algorithmic trading. We don't see evidence of value investors coming in to establish long positions at this particular point in time, and all the evidence is there that equity prices are expensive, so it's not likely we're going to see value investors. One of the things that we should look into is the amount of cash sitting on the sidelines. After the move in August, I would imagine that a lot of cash was put to work, but it remains to be seen as to how much cash now is sitting out waiting to be invested. A lot of portfolio managers have year-end coming at the end of December, and their mandates would require them to get any excess cash that they're sitting on invested. So that is something that we'll have to have a closer look at to see what is revealed. But I would imagine there's not a lot of cash sitting on the sidelines, Paul, and it could in fact be short covering and a lot of algorithmic type trades that have driven the market higher. Volume has been light, as I mentioned before, and often if a market is riding higher, not driven by volume, it is certainly a market that's on shaky legs.
Yeah, that's a good point about cash on the sidelines or mutual funds around the world, but maybe we'll look into that next week. Thanks.
Yep. All right. Well, there's no questions from the listening audience, but anybody listening to the recorded version, if you do have questions, wish to email them to us, we would be more than happy for you to send them. We'd love to get feedback on these webinars. We really want to know what people want to hear us talking about, so that it makes sense for you to listen. And we'd love to hear from you if you have anything that you'd like to hear from us on either a regular basis or a one-off situation. Well, that's it for another week. I want to thank you all for taking the time to tune in. Have a great rest of the week, a good weekend, and we'll be back with another report next Tuesday. This is Scott Tomlinson signing off.